while the FOMC declined to raise rates at its most recent meeting, keeping it steady at a 22-year high. The dot plot showing that most Fed officials still think one more hike is necessary before the end of the year. On this, we want to bring in Esther George, former Federal Reserve Bank of Kansas City CEO and president. Ms. George, it's great to have you here. Thanks so much for taking the time to join us. So I think investors are still digesting what we heard from Chair Powell yesterday. But when it comes to those projections, right, that was the main focal point. The fact that officials still think that one more hike might be necessary before the end of the year, and we could be in this higher for longer environment through 2024. What's your reaction to that?
Yeah, well, good morning, and thank you for having me. I think as you look at the messaging coming out of the Federal Reserve, and again reiterated yesterday, this is a committee that wants to keep the focus on its restrictive policy, bringing down inflation. They have been very clear that they want to get back to that 2% target. It's proved to be a little bit tougher in terms of a timeline for doing that. And so the messaging yesterday, including the dots, I thought were really trying to keep the focus on higher for longer in order to bring that inflation down.
Does this sound to you like a Fed that believes firmly in that a soft landing is going to be achieved?
Well, you heard the chairman ask that a couple of times yesterday. And clearly, this committee does not want to damage the economy. They would love to see those imbalances between demand and supply work their way out to a soft landing. The truth is, though, that isn't guaranteed. And really, the goal of that committee is to restore price stability. A soft landing would be a scenario where they're able to do that with little impact to the labor market. And you see that in their dots. On the other hand, they have also said there could be some pain involved in trying to restore price stability. And that pain typically comes in the form of a higher unemployment rate. So I think they're looking at a variety of scenarios at this point. They're getting close, they think, but not yet ready to say they've arrived at the destination.
Ms. George, what do you think is most likely at this point, given what we heard from the Fed yesterday? Do you think a soft landing is more likely, or maybe we'll see the other scenario that we've been talking about a hard landing?
So as I look at the outlook for the economy, clearly the consumer has been resilient, but I am also watching the fact that these excess savings, this money that has really shored up the consumer over the last few years, is waning at this point. We also see the uncertainty coming from strikes by auto workers and others. We see the threat of a government shutdown. And we also see globally that some of our trading partners are in a weaker position than we are with their economies. And so all of those things, to me, are a confluence of areas to watch that could hit the economy at some point. And finally, I would say, when you have this kind of a rate hike, 500 basis points plus, at a time when the Fed is also shedding its balance sheet, you are getting restrictive policy. And as that works its way through the economy, that, of course, can create some downdrafts. So I'm looking at a number of things that threaten that soft landing scenario. I think they're legitimate. I hope they don't come about. It would be great if the soft landing were the outcome. But I think the reality suggests that we need to be focused on what some of those risks are.
And when we think about what the Fed was expected to talk about coming into this meeting, oil was expected to be on the docket of conversation. Do you believe that we got any clarity about how the FOMC voting and committee members are looking across where the range of prices are that consumers are incurring and businesses are incurring as well for producing goods, and saying and assessing the broader oil or energy portion of those costs too?
Yeah, I think you're right. And I have to believe this was a central part of their conversation yesterday. We'll see when the minutes come out in a few weeks how they were judging energy markets, for example. But you're right. Anytime energy and food prices are at the levels they are today, they are hitting the consumer directly. And even though the Fed can look through those headline numbers and look at the core, we do know that higher energy costs when you pull up to the gas pump and fill your car is front and center in the minds of consumers. It does impact their ability to pay for things, to make trade-offs, the same with food prices. So those two things are very salient in the mind of households in terms of how they look at forward inflation, in terms of how good they feel about the economy. And I think today we know from looking at various consumer surveys, consumers don't feel very good about the economy, and that most certainly has to do with those prices in particular that they're facing.
Do you think then we'll see a further deterioration in the consumer? Because up until this point, the consumer has remained so resilient. And when you compare what we're seeing today to what we were hearing from forecasters 6 to 12 months ago, we're looking at a totally different scenario.
Yeah, no, that's true. The thing in the favor of the consumer right now is the low unemployment rate. So to the extent that people have jobs, their wages have been going up, that gives people confidence and they will spend. On the other hand, we know that a lot of the demand we saw coming through the pandemic came from these excess savings, money that was transferred from the government's balance sheet to households and small businesses is running down. And the question is, will the consumer hold on to that in a cautionary fashion? Will they continue to spend out of that excess savings? Will they begin to borrow to maintain this level of expenditure while prices are high? Remains to be seen. But I think you have seen some moderation in consumer behavior, and I think we will continue to see that over the coming months.
And just lastly, while we have you here, as we think about the potential for a cut at some point next year, if you're sitting in the committee and you're thinking about what is going to, at the other side of whatever type of landing we do get, spur demand, drive people back into the housing market, how soon would you be anticipating or thinking about a cut?
Well, it's hard to pinpoint the time frame for that, but I think some of the things that this committee might be looking for is what happens in the labor market. The labor market gives a signal of whether demand has fallen in a way that causes businesses to turn loose of people. And of course, right now, we don't see that. In fact, just the opposite. People are hanging on to their workers because of how difficult it was to attract and retain them over the last few years. So I think pushing out the expected rate cuts is probably right, given the scenarios we've seen. On the other hand, I think at the end of this year, you could begin to see the impacts of the uncertainty around this government shutdown, around some of the strikes and the shutdowns that have happened in the auto sector. There could be other things as this tighter policy works its way through that will signal the economy is cooling in a way that the committee will not only be comfortable leaving rates, but anticipating those cuts sometime in the first half of next year.